Tighten your belts because personal finance is about to get harder in the UK. This year, the government announced some major changes to income tax and pensions which impact pretty much everyone. So without further ado, let's jump into the changes. So what are the changes? For the tax year 2023-2024, the personal allowance remains frozen at $12,570, and that will remain frozen until 2028, as the Chancellor Jeremy Hunt confirmed in the last budget. But for those of you who aren't quite sure what the personal allowance is, it's basically an amount which is not taxable. So for example, if you receive an income of £30,000, you only get tax on the difference between the income minus the personal allowance. Similarly, the high tax threshold is also being frozen at its current value of £50,270, and that's until 2028. Now, you may think that freezing the personal allowance and the higher rate threshold is a good thing because at least they're not being reduced, right? Well, you may be surprised, and we'll get to that later in the video. On the other hand, the additional tax rate threshold, previously at 150k, will now be reduced to 125,140, which means you'll now start paying the 45% rate when you cross this threshold. It's also worth pointing out this is the same point where your personal allowance falls to zero, as basically for every £2 above 100k, your personal allowance reduces by £1. So that's probably where this odd looking number comes from. Moving on to your allowances, the dividend allowance of 2k is slashed to 1k from April 2023 and slashed again to £500 in 2024. Same story goes for the capital gains tax allowances. The allowance of $12,300 will be slashed to 6k this year and half again the next year to 3k. There are no changes to national insurance besides the 1.5% increase reversal in November, which did create a bit of a mess. These changes mentioned above apply to both Scotland as well as the rest of the UK. Now, how do these affect you? As mentioned earlier, the freezing of the personal allowance and tax thresholds can seem neutral as nothing seems to have changed. But that's a misconception because generally, with inflation, this monetary value is worth less as the cost of living rises. This is made even worse with current high inflation rates. So for example, with the 10% inflation, your personal allowance is worth only £11,426. That's over £1,000 less within 1 year. Isn't that crazy? Now imagine freezing the personal allowance until 2028. That means this value will reduce even further. Assuming the inflation is eventually brought under control to a 3% value, that means by 2028 your personal allowance would be worth only 10k. In the meantime, as it's very likely that your income will increase to keep up with inflation, that means more of your income will become taxable. Regarding the additional tax threshold reduction, this is expected to affect only a small segment of the population, as only about 2% of Brits earn over that threshold according to a survey by the Office for National Statistics. Moving on to the reduction in dividend allowance, this halving of the allowance to 1k means that you're more likely to be taxed on dividends, which is something you probably didn't have to worry about unless you had a very large investment portfolio. Now, this very much also depends on your dividend yield from your portfolio. A 2% dividend yield means you'll start paying tax on 50k investments instead of 100k previously. If you have a high dividend yield, say 4%, you'll start paying tax if your portfolio exceeds 25k. That's for this year. For the next year, that halves to 12.5k. Which is pretty low threshold to pay dividend tax on, if you ask me. Same story goes with the capital gains tax allowances halving twice, so from 12,300 to 6,000, then to 3,000 the year after. So whenever you sell your shares or other assets, you need to watch out not to go over the threshold. The difference here is that you have some control on when and how you sell your assets as opposed to the dividends. Which brings me to the next section. How can you mitigate the impacts of these changes? Well, I've said it before on this channel, make the most of your ISAs if you're able to. If you don't, you lose the 20k allowance every year. Remember, any income or gains within your ISA is not taxable, so therefore you should make the most of it. Next is make full use of your pensions, unless you plan on retiring early and living the FIRE life, in which case you should also check my other videos. Then there is no reason why you shouldn't contribute towards your pension. Your contributions are given tax relief, meaning that you get the tax back if you paid any. Now, that money gets invested until you retire, so think of the compounding that could take place. If you're confident with managing your retirement money, you could use a SIP, also known as the Self-Invested Personal Pension, to choose where your money is invested. There isn't much you can do to avoid the dividend tax liability given the lower threshold, other than perhaps choosing investments with low dividend yields. However, I would caution against this, as your primary goal in investing should consider risks and returns as primary factors, whereas tax liability to a lesser extent. That said, investing specifically for dividends may not be the optimal strategy anyway. I recommend watching this video by Ben Felix, who goes deeper as to why. The link is also in the description below. Finally, moving on to the capital gains allowance decrease, there is slightly more wiggle room because you can choose when to buy or sell your assets. If you have a buy and hold strategy, you're less likely to be affected because you only incur the tax when the asset is sold or disposed of, as they call it. Because your capital gains tax allowance is reset every year, you could decide to reduce future tax liability by selling and buying the investment again to fully utilize your allowance. If you repeat this every year, you could save a decent amount on tax. It should be noted, however, that this strategy requires consideration of the transaction costs of buying and selling, as well as the minimum waiting time between buying and selling, currently set to 30 days. Another tip is to remember when to offset any past capital losses against the capital gains this year. As per my understanding, you can carry forward capital losses in the past 4 years to offset against current capital gains, but speak to your advisor if you have one. I'll put a link in the description below on a Vanguard article which discusses the topic of reducing capital gains tax in more detail. So there you have it. Personal finances aren't looking favorable for the next few years, but hopefully I have shown you a few tips on how to mitigate their impacts. If you found this useful, remember to like and subscribe. Thank you for watching and see you next time.